Right, good afternoon, everybody. Today we will continue the income taxation LKS 12. It's about today's session is about introduction to deferred tax and tax base. So I am Mr. M.I.M. Riyadh. Uh, right. Right. We'll continue from this slide. Um, in the previous session, we have talked about the background information and background information about uh, income tax under LKS 12. Today we will discuss about what is deferred tax. So what is deferred tax? So I already explained you deferred mean the future tax, right? Deferred tax mean future tax. So due to some differences uh, in future, there will be uh, an obligation to pay tax, or there are some possibility to recover the tax, right? So when a company recognizes an asset or liability, it expects to recover or settle the carrying amount of that asset or liability. So you have studied under the framework, right? SLFRS accounting framework. So you know what is the definition of asset and liability. In case of asset, so you will get a future benefit. A firm, the entity will get a future benefit. So recover. In this slide, we call it as a recover. So if we have an obligation, um, so the obligation that should be settled in the future, right? So the settle belongs to the liability, recover belongs to the asset. So in other words, it to sell or use expect to sell or use up assets and to pay off liabilities. So if we have asset, right, we have rights to sell that asset, that resources, or you can use that asset for your profit making purpose. In case of liability, you have to settle off, you have to settle down the liabilities, that's mean pay off, you have to settle. So what happens if that recovery or settlement is likely to make future tax payment larger, right? What happens, right? If that recovery in case of asset or settlement in case of liability is likely to make future tax payments, it may be larger or smaller than they would otherwise have been if the recovery or settlement had no tax consequences. And you can understand what is the deferred tax, right? What's the meaning of this? What do you mean by recovery, settlement, tax consequences, right? You will be you will be understood well, right? So at the initial stage, it is very difficult to understand the things, right? Uh, in these circumstances, LKS or IAS 12 requires companies to recognize a deferred tax liability or deferred tax assets. So in the last class, I have explained you so why differences are occurred, and I have explained at the beginning what is accounting profit, what is taxable profit. To find the accounting profit, we follow accounting rules and regulations. To find out tax profit, we have to follow the rules of the tax authorities. Keep it in your mind, right? And current tax mean the tax for the period. Current tax is the amount actually payable, not an estimated amount. It's actual amount, actually payable to the tax authorities in relation to the trading activities of the entity during the period, right? So if there are so many transactions, events, right? So that transaction events will generate profit and capital gains. On that profit and capital gains, and an entity, a company, should pay tax to the government, right? So that tax should be calculated based on the rules and provisions of tax authorities of the country, right? The deferred tax, again I remember you, deferred tax mean the future tax. So current tax is a tax for the current period. Deferred tax mean the tax, the obligation in the future. Some, for your understanding purpose, you can rename it deferred tax as a future tax. Deferred tax is an accounting measure, right? It's an accounting measure. So the term deferred tax is no more available in uh, income tax, right? The calculation of income tax, but it's an accounting arrangement. So future tax is an accounting measure uh, used to match the tax effects on transactions with the accounting impact, and thereby produce uh, less distorted results. So, as you remember, you might studied about the case balance and the bank balance. Most of the time, the bank statement balance and the figure in the cash books of bank balance differ, and we prepare bank reconciliation statement to find out the differences, the cause of differences, and we reconcile the figure, right? We try to distort the deviations. Likewise, we calculate profit, accounting profit, by following accounting rules. When we calculate taxable profit, we follow uh, the rules imposed by the government, tax authorities. So most of the time, there are some differences between accounting profit and taxable profit. So we have to reconcile, right? We have to reconcile. So to reduce that sort of deviations, we use deferred tax adjustments, like bank reconciliation statement. So in here we use deferred tax arrangement. So uh, we have to make some arrangement to reduce the differences, contradictions in between the accounting profit and taxable profit. Deferred tax arises from the differences between profit calculated for accounting purpose, right? Keep in your mind, uh, the deferred tax arises, the future tax arises due to the differences between accounting profit and the tax profit, right? Deferred tax arises from differences between the profit calculated for accounting purpose and profit for tax purpose. Right? Simply due to the differences of accounting profit and taxable profit. Difference may arise from temporary or permanent factors. Temporary or permanent factors. If you studied taxation, it's very easy to understand what is taxable profit. And I hope already you have studied as a subject taxation, right? So here, this is the mind map, the summary of deferred tax. uh, summary of what we are going to study. So deferred tax is arises due to the differences between accounting profit and taxable profit, right? So if anybody of you unable to understand what is taxable profit, you can post your question in the chat box, or you can unmute your mic and you can ask. And right, so these differences occurs in two ways. The one way, the one reason is permanent difference. The second reason is a temporary difference. Permanent means a permanent, right? Permanent means permanent. Temporary means it lasts for a short period of time. So the differences, right? The differences occurs due to the time difference. You can understand easily. Uh, Wait for a while, right? Permanent differences. The permanent differences where an expense charged in the income statement is not allowed for income tax purposes. Can you tell me example of expenses which are not allowed to deduct as an expense for the tax purpose? If anybody of you, for your better understanding purpose, I ask you this kind of questions. Please use this opportunity to interact with me, right? Don't be silent there all the times. Please post a question. Can you post some example, right? Any idea? Can you hear? Is it audible to you all? Is it audible?
Yes.
Okay, then can you tell me some example for tax purposes that expenses are not considered as an expense? Say, for example, a donation. A donation, when we calculate uh, accounting profit, we can deduct the donation as an expense. But when we calculate profit for the purpose of tax payment, the donation expenses normally not deductible expenses, right? Uh, do you know what's the difference between what is taxable profit and accounting profit? So if you don't understand, if you don't know that clearly, you can't understand anything hereafter. So if you are not studied taxation, please tell me. Then I will explain briefly by taking 5 minutes. I will do small sum to explain the differences between the taxable profit and accounting profit. So if you be silent, what do I assume? Any volunteers? If you don't understand the differences between the accounting profit and taxable profit, is useless, right? Talking, teaching without knowing that is useless. Have you studied taxation? Oh, yes, okay. Then I will take 5 minutes to teach what to explain what's the differences between taxable profit and accounting profit. Okay. Uh, right. Can you see Excel sheets? Can you see Excel sheets?
Yes, sir.
Please respond to my questions. Can you see?
Yes, sir.
Okay. Right. Now we will calculate here sales and sales. Say for example, 100,000 and cost of sales. Say 20,000 and gross profit. How much? Equal 80,000 and admin expenses. And admin expenses assume it's about and admin expense say salary and salary for about 8,000 and rent say 2,000 and selling expenses, the advertisement say 3,000 and delivery cost 2,000 and right, other costs, other expenses say other expenses, say for example right, a donation about 20,000 and entertainment expenses about 20,000. Then how much accounting profit? If anybody, can you anybody of you calculate and tell me how much accounting profit? Profit before tax. So total admin expenses 10,000 and total selling and distribution expenses 5,000 and other expenses 40,000. How much profit before interest and tax? How much? How much profit before interest and tax?
25,000.
Um, 3,000 minus minus. Okay, how much? 25,000, right? Profit before tax is 25,000, right? So, for example, there's no interest cost, no finance cost, assume that, and corporate tax rate is 50%. Then how much income tax? How much tax? How much tax? Anybody of you?
12,500.
Good, 12,500. Good, right? Nobody of you has no doubt regarding this. So this is called what? This profit is called accounting profit. accounting profit, right? It's clear to all, everybody of you. It is clear. This concept is clear, right? So we calculate this profit by following accounting rules and regulations, right? Now, uh, normally, people willing to pay more tax or low tax to the government. People willing to pay more tax or less tax,
Less tax.
less tax. So therefore, what they are try to do, so they try to normally the companies are try to minimize the accounting profit, right? So for example, here depreciation, I put depreciation, right? Depreciation, I put depreciation here. How much depreciation here? 2000. When the company take 2000 as a depreciation, and here the income tax is 50, income tax is 12,500, right? Right. So the same thing, right? Everything are equal. Everything's are equal. This is company A. This is company B, right? Same machine, right? The company A and B are having same machine, right? Uh, for the same machine, this company provide allocate depreciation 2000. For this company, charge depreciation 4000. Is it possible or not? Is it possible or not? For the same value of asset, a company A and B are following two different rate of depreciation. Does it possible or not?
Possible.
Possible or not?
Possible.
Possible, right? Good. Now, uh, so due to increases in profit, increases in depreciation, what happened to the accounting profit? What happened to the accounting profit?
Has been reduced.
Yeah, it has been reduced. It has been reduced into 23,000. Here, company A pays 12,500 as a tax, but company B pays 11,500 as a tax. So the company tries to minimize. And the donation, right? The donation, right? The donation. Uh, Here, this company pays donation 60,000. Sorry, 40,000 donation. Then how much tax? How much tax? 1,500. All operations are equal, but the difference arises due to what? Here, they charge 2,000, B company charge 4,000. So due to the differences in the accounting depreciation policy, the value of depreciation is differ, right? The B company try to increase the depreciation as a cost. Therefore, the company pay less tax. And also, to reduce the amount of tax payable to the government, company B spend 40,000 as a donation. Is it possible or not? Is it possible or
Possible.
not? Also possible, right? So to minimize this kind of malpractices of companies, government uh, issues, government imposes a unique rule for all companies, regardless the type of company, whatsoever, right? They are using a unique rule for all. Here in this here, in case of depreciation, company A allocate 2000 and company B allocate 4000. It's a difference, right? So to minimize this kind of deviation, the government says, no, you can't decide the accounting depreciation, you can't decide the depreciation. We will we will decide. We will give you how to calculate depreciation. Then when they calculate the tax profit, they have to follow the rules of the government. Here, say for example, in this example, the value of the machine is 10,000. Value of the machine is 10,000, and the lifetime of the machine, uh, for a company A to company A, useful life 5 years. Therefore, depreciation 2,000. And for company B, they are follow how many years? B company decides for the same asset how many years? Useful life how many years? 2.5, no? 2.5 years. 2.5 years, right? The company, right, for example, the B company assumes here 2 years, right? 2 years useful life. Then what will happen for the depreciation? How much the depreciation will be? How much? The value of asset 10,000, useful life of B company 2. Then how much? Depreciation
5,000.
5,000. Then how much? Here tax tax will be reduced. So for the purpose of paying less amount of income tax to the government, they are doing some policies. Now they are meant policies to remove this kind of discrimination among companies. Say, for example, uh, to follow a unique rule to all companies, the government decides that uh, all companies should depreciate the asset for 10 years. Government rule is government rule is what? They have to depreciate the asset for 10 years. Then how much? The accounting profit of B company, according to the new rule, new rule, depreciation how much? Depreciation
1,000 rupees.
how much?
1,000.
1,000. Good. Depreciation 1,000. And the donations. I ask one question. Does the donation contribute for making profit or not? Donation will contribute to make profit or not? Donation. So this salary, the advertisement, right, delivery charges, right, rent, all these payments are contribute to making profit, right? The donation, do you think the donation expenses, donation will contribute to make profit for the company? Yes or no?
No.
No, good. Then the government says if any expenses which are not contribute to make profit, that expenses are not deductible, then the donation expense equals zero, right? Entertainment, entertainment expenses, right? Entertainment. They are making some funds with the employees, or they set up a trip to Hong Kong, 10 days trip, right? So such kind of entertainment expenses will contribute, does contribute, will contribute to making profit or not? Entertainment, getting fun, making fun, expenses, will it contribute to make profit? Yes or no? Yes or no? So please unmute your mic and tell, right? Entertainment, fun expenses will contribute to make profit or not?
It contribute.
Will not contribute. Therefore, the government rule says no. They can't allowed to deduct entertainment expenses. Right? Here, how much profit now? Profit, how much? Profit, how much? Accounting profit, 66,000. Accounting profit. See the company B, their income tax 1,000 rupees. All are the same, right? Here, in the first instance, A company, right? A company and B company both are similar in nature, right? Both of them are having same amount of sales, cost of sales, operating expenses, everything. But so here the company A charges 2,000 depreciation, company B charges 5,000 depreciation. They differ, but government make it's a unique depreciation, right? And here donation, here they are 20,000 entertainment. So why they are doing this kind of expenditures? Uh, they try to minimize tax payment. So therefore, government to avoid this kind of malpractices, they introduces rules time to time. They introduces new rules to make a unique accounting procedure to find out the taxable profit, right? So we say it is not a profit before tax, it is called taxable profit. Taxable profit here, uh, for A company 20,000, is it accounting profit or taxable profit? For A company 20,000, accounting profit or taxable profit?
Accounting profit.
Because why? What's the reason?
Calculate using accounting theories.
Yes, exactly. Very good. And company B, 2000, accounting profit or taxable profit?
So the account
For B company also follow accounting rules. But the same B company, for the tax purposes, they follow tax rules. Then this 66,000 taxable profit or accounting profit is a taxable profit, right? Here, how much the differences here? A big company already they have 2,000. Big company had 2,000 according to the accounting rules, but for the tax purpose 66,000, right? So what are the reasons for these differences? How much difference between accounting profit and taxable profit of B company? How much differences? How much? How much? My dear students, please respond to my questions. It's an
64.
interactive session, not a speech, right? It's an interactive session like classroom. So how much differences between accounting profit and taxable profit of B company?
64,000.
64,000.
64,000. 64,000. Due to that, here the huge differences between the tax, income tax, right? Um, right. Here, as I already told you, the deferred tax arises due to what? Due to what? The deferred tax arises from the differences between profit calculated for accounting purpose and tax purpose. Have you understood the idea?
Yes.
Clear? Deferred tax arises due to what? Due to the differences between accounting profit and taxable profit. And again, it says the differences may arise due to temporary factors and permanent factors. Here, the permanent factors and temporary factors. Here, in this example, right here, the depreciation, right? The depreciation is a temporary, it's a temporary factor, right? Temporary, but the donation and entertainment expenses are permanent differences, right? Permanent factors. Donation and entertainment expenses are example for permanent factor, and depreciation is example for uh, temporary factor, right? I know that most of you understood why I am saying. Most of you are not understood that why I am saying depreciation as a temporary and donation as a fixed, permanent. I will explain. Don't worry, right? Right. At this moment, my objective is we have to understand the differences between accounting profit and taxable profit. Have you understood clearly the differences? Have you understood? Okay, right. Now, after if you understood the differences, then your life will be easier, right? You can understood very well, clearly, right? Here, the permanent difference where an expense charged in the income statement is not allowed for income tax purpose. Here, so donation and entertainment expenses. Here, the charge and expense and donation and entertainment expenses charged in the income statement is not allowed for income tax purpose, right? Here, an expense charged in the income statement is allowed for income tax purposes as well, but there is a difference in timing of such allowances. Here, again, I come to the point, temporary and permanent, right? The donation and entertainment expenses is allowed or not allowed in accounting in calculation when we calculate the taxable profit, allowed or not allowed?
Well,
Donation and entertainment expenses, allowed or not allowed
not allowed.
in accounting profit?
Allowed.
Allowed. So if any expenses allowed in accounting profit but not allowed in taxable profit, it's coming under permanent difference, right? It is coming under permanent difference, right? The depreciation is allowed or not allowed in taxable profit, allowed or not allowed, allowed or not allowed?
Allowed.
Allowed. Both. In account, when we calculate accounting profit, it's allowed. When we calculate taxable profit, allowed. So but the amount is different, isn't it? The expenses are allowed, but the amount is different. Why these difference arises? Why? What's the reason? What's the reason? The reason is the time. The reason is time. The company says we can the useful life of the asset 2 years, but government says no. You have to use it for you have to depreciate it for 10 years. But company says no, we are going to use for 2 years, right? So due to this time differences, right? Due to the time differences, the amount of depreciations are differ. Amount of depreciation are differ. So therefore, it is categorized as temporary difference. Understood? These are the most important concepts. Have you understood the differences between permanent and temporary? Yes or no?
Yes, sir.
Yes or no?
Yes, sir.
Yes.
Yes, sir.
Can't you understand? Clear?
Yes, sir.
Okay, good, good. Right, right. Now we come to the point. The permanent difference. These occur when certain item of revenue or expense are excluded from computation of taxable profit, right? For example, a donation and entertainment expenses are excluded. It mean we are not include when we calculate the taxable profit. For example, entertainment expenses may not be allowed for tax purposes. Entertainment expenses are not contribute to make profit of the company. Therefore, the government is not allowed to deduct as an expense, right? So due to that reasons, the difference arises called permanent difference, right? Now we come to the temporary difference, right? The temporary difference is very important, right? Rest of the sections are will based on the temporary differences, right? The temporary difference, this occurs when items of revenue or expense are included in both, right? Included in both accounting profit and taxable profit. Say for example, depreciation, it includes accounting profit also. Yeah, when we calculate accounting profit also, we include as an expense. And when we calculate taxable profit also, we include depreciation, right? But not for the same accounting period, right? The same accounting period. The government says 10 years, but the company says 2 years. For example, an expense which is allowable as a deduction in arriving taxable profit in 2017 might not be included in the financial account until 2018 or later, right? Okay, I will explain, right? In long run, the total taxable profit and total accounting profit will be the same except the permanent difference. So that timing difference originates the one time and are capable of reversal in one or more subsequent period. Deferred tax is the tax attributable to temporary differences, right? I will explain, right? I will explain what this meaning, what the meaning of this paragraph, right? I will explain. Again, we'll move the Excel sheet, right? Right. For example, we assume a company A, right? Machine. The cost of the machine is 10,000. Cost of the machine, not yeah, 100,000, right? Cost of the machine is 100,000. Useful life Useful life, useful life is 4 years. Useful life 4 years. Assume that their profit, right, gross profit of company profit of company A, say 500,000, 500,000. Profit before depreciation, right? Profit before depreciation, 5,000. And depreciation. How much depreciation according to the accounting rule? How much?
25,000.
Very good. 25,000. Then profit after depreciation, how much? How much profit after depreciation?
475,000.
Right. Now assume tax rate is 50%. Then how much income tax? 237,500. Right? Right. But now the government says, right, before that, this is year one, right? So we can go for up to 4 years, right? Assume that the same profit and depreciation also same for all period, and this is also equal, right? We can depreciate up to how many years? 4 years, right? In the year five, how much? Do you have any depreciation balance in the year five?
No.
Very good. Then how much? Right. Right. All of you have clear idea. Right. Now the government says the depreciation should be not for like useful life 2 years. Useful life not 4 years. Now the government decided, then according to the government rules, how much depreciation year one? Year one depreciation how much?
50,000.
50,000. Yes, 50,000. And year two, how much?
50,000.
50,000. Year three, how much year three?
No depreciation.
Very good. Excellent. Very good. Very good. Right. So this is what? Accounting, not accounting profit. Taxable profit. Taxable profit. Right. Right. Up to 5 years, can you find the total of the income tax paid? For 5 years, how much they have paid tax, total tax? Equal or different? The total amount paid to the government as a tax for 5 years, equal value or different value? Equal value or different value? Both are equal or different? Is my calculation right or wrong? Total tax payment for last 5 years based on accounting profit and taxable profit. Is it confusing? You have to have a very clear idea on this. You have to have a very clear idea on this. From this example, we have to study so many concepts in the standard. Equal or different amount, total amount paid to the government by the company for last 5 years?
Equal.
Different or same?
The same.
Very good, right. But the year one, how much difference? In the accounting, right? Accounting, based on the accounting profit, he paid 237,000, but according to the taxable profit, like that. So what happens? What happens here? Difference. What happens? Here, so I will explain from this example. I will explain you what do you mean by a deferred tax, right? Deferred mean what? What do you mean deferred? Deferred mean what? Deferred mean? Deferred tax mean what? Future tax, right? Deferred tax mean future tax. Here, uh, company allocated depreciation 25,000, but government says not 55,000, not 25,000. Here to you have to deduct 50,000 as a depreciation. Due to that, tax has increased or reduced. Tax obligation of the company in the year one has increased or reduced.
Reduce.
Reduced. Is it profit or not? Is it for the company? Is a benefit or not?
Benefit.
Benefit, right? It's a benefit. How much benefit?
12,500.
12,500, right? 12,500. The second year, same thing, no? Second year, 25,000, but government says not 25,000, 50,000. Then how much benefit? Again, 12,500. What about year three? What happened to year three? The accounting people says, our company people says, we have to deduct depreciation 25,000, but government says what? Government says you are not allowed to deduct depreciation in the year three. Yes or no? Yes or no? The company willing to deduct 25,000 depreciation in the year three. Here in the year one and year two, companies are happy, no? Company is very happy, isn't it? Company is very happy because they have tax saving of 12,500. But in year three, what happened to them? What happened? What happened to the company?
They have to pay.
Yes, they have to. They are expected to pay 233,500 tax, but government says no, no, you have to pay 250,000. Same things happen year 4, right? Right. It's mean here the year 1 they are saving how much? 12,500. Actually, it's an asset or liability to the company. This 12,000 saving is asset or liability to the company.
Assessed.
It's an asset. Any other? I'm says no, it's not an asset. It's an obligation. Yes or no? Here, here they are saving. They are saving means in the future they have to settle it. Yes or no? If under the framework, under the framework, what's the definition of liability? There will be an obligation. There will be a future obligation, isn't it? So due to the differences in the depreciation amount, they are having a saving of 12,500. So this saving will be payable or not in the future. This 12,500 is payable or not in the future, the saving. Actually, this is a liability or asset or liability. Think. In the year 1, you have saving 12,500, but that is not an actual saving. You have reduced the tax, but if you are paying less amount of tax, it's mean in the future you have to set that. You have to settle. That's why here in the 5 years, the total tax amount are equal, isn't it? But when we see the year by year, the tax is different. But yeah, tax is yes, isn't it? So based on the accounting rule, here uh, we are paying high tax, right? According to the government rule, tax authorities we are paying less amount of tax here. For the first year and second year, we are paying less amount of tax. Here, see the values. But in the year 3 and 4, we pay more tax. Year 1 and 2, we paid less tax, but year 3 and 4, we paid more tax when compared with this. So actually, this 12,500 in the year 1 is an asset or liability. It's an obligation or not? Please
Obligation.
respond. Liability or asset?
Liability.
Liability, yes. This liability is a liability. This liability is called deferred tax. This amount is called what? Deferred tax. So we have to pay, no? In the future, we have to pay. Yes or no?
Yes.
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 We have to pay. It means we have to pay the tax in the future. How much current tax here? Current tax how much? Current tax income tax for the period how much? 225,000, right? Current tax 225,000. Deferred tax how much? Deferred tax liability this amount. And year 2, current tax 225,000. Deferred tax liability 12,500. Right? So it's an obligation. In the future, we have to pay tax. We have to pay tax. Clear?
Yes, sir.
Okay. Now we have lectures in the 5 o'clock. Shall we continue? We have lectures after 5 o'clock. We'll continue, right? We'll continue. Right. So now we can understand what the meaning of this paragraph, temporary difference. So this occurs when times of revenue or expense are included in both accounting profit and taxable profit, but not the same accounting period, right? Not the same accounting period. Here, year 1, year 2, year 3, year 4, right? They're different, right? For example, an expense which is allowable as a deduction in arriving at taxable profit for 2017 might not be included in the financial account until 2018 or later. So, in the long run, the total taxable profit and total accounting profit will be the same, isn't it? In the long run, total taxable profit and total accounting profit will be the same, isn't it? Except for permanent differences. So that timing differences originate in one period and are capable of reversal in one or more subsequent period. That's what here explains. Here in the year 1 and year 2, we have some what asset deferred tax liability. Then in the future we have to pay this one. In the future we have to pay. Here we estimated this amount, less amount, but we estimated in the year 1 and year 2 high amount based on the accounting profit, but actual payment is less amount. But it will be recoverable, settled, right? The low amount, the saving, it will be settled in the subsequent period, the next period, in the future. That's why we are called as deferred. Deferred mean we have postponed future tax, right? This future tax, deferred tax arises due to what? Due to the time difference. Here, 4 years according to the accounting rule. 4 years according to the government rule. 2 years. So this is a time difference, right? This is a time differences. So deferred tax is the tax attributable to the temporary differences. Uh, Key definitions. So tax base of an asset or liability is the amount attributed to the asset or liability for tax purposes, right? Um, and tax expense. Tax is an expense, right? Tax is an expense. Tax expense comprise current tax expense and deferred tax expense, right? The tax expense include both. Here in this example, uh, here deferred tax based on the accounting rules, they estimated 237,500, but the actual amount is here this value 225. So this amount equal what? Current tax plus deferred tax, estimated tax plus deferred tax here, right? Um, and so tax income. So when a company generate profit, they will pay tax. What is tax income? What is tax income? When company make losses, what to do? Do company pay tax?
No.
When companies make profit, do company pay profit, pay taxes?
No.
No. Then what's the solution? If company makes profit, you have to pay tax. And company make losses, then who should pay tax to the company? Who should pay tax to the government, to the company?
Government.
Government, yes. But in practice, government never gives tax to the government. So the government never pay tax to other entities, companies. Right? They can set off in future. They can set off in the future when they are making losses. You can claim that. You can claim. So that time we call as tax income. Tax income, right? So the tax expense comprises current tax expense plus deferred tax expense. The tax income comprises current tax income and deferred tax income both. Income tax means any tax on profit and gains payable by the entity, including corporate income taxes and capital gains. So simply income tax mean the taxes imposed on profit and capital gains of the company. Then we will stop the class. We will continue tomorrow from this slide number 8 onwards. Same time tomorrow. You can use the same link that I have sent you today. If you have any questions, you can ask until you register your attendance. Okay, then thank you very much. We will meet tomorrow.